Three things to talk about on the Gray Report this week. One, are we at the beginning of a generational reset of commercial real estate prices? People are asking, should we still wait to buy for cheap, or is cheap today? Second piece, we had a blockbuster revision to jobs reports last week that through the last Fed meeting, just the chips are all up in the air. Will we see a rate cut later on at the next meeting in September? And what does this mean for the economy and commercial real estate? And then lastly, are we seeing a market slowdown in apartments, specifically apartment rents? We've seen a slow leasing season throughout the spring and summer. What does that mean? And is maybe there a relation between that and the weak job report? We're going to be talking about all of that and more on this week's episode of the Gray Report. So if you're an active investor or passive, you're in the right spot. Breaking it all down, Dr. Matt Bosnagel is in the seat producing the show. Once again, let's get into it. Welcome back to the Gray Report, joined again by Dr. Matt Bosnagel. Matt, how are we doing this week?
Pretty good. It's been a really interesting week. A lot of up and downs and a lot of stuff where even as it was happening, I was like, this is going in the Gray Report. So fun from my perspective.
so Matt, it's always a fun and exciting week on the Gray Report, but this last week has been exceptional because, we recorded last week's episode right before the Fed meeting press conference. The next day, they come out with this jobs report and then a revision to the prior 3 months jobs report that basically shows we really haven't added that many jobs to the economy. So tons to talk about. It is really having everyone rethink the macroeconomy. We talk about macro a lot here in the Gray Report. Talk about interest rates. We talk about the Fed. We talk about how that relates to commercial real estate. And I can't think of another pivot point like we may have seen last week. I know we're going to talk about that, the whole segment, but there's this other idea that you've mentioned that you've seen in a number of publications, this concept of this generational reset for commercial real estate. We talked about it. There's like a John Burns research consulting piece we talked about a couple of weeks ago, a couple of new piece from, I think, CBRE. What's the conversation about this reset? What are we resetting here? What's going on?
Well, this is referring to the long-term cool down that we've had of the past 2 years, and the argument is that the reset is that we're going to stop cooling down and we're going to start recovering. I think that the overall thesis is after long periods of cooling prices, there tends to be an accelerated increase in prices, and they are comparing the cool downs in the early 90s and the Great Financial Crisis as two other periods where really as two other periods where there was cool downs and then subsequent increases on the tail of those cool downs. There's a lot of reasons to think that this could be true. I think that there's what I was gaming out really after reading this was the things that I thought maybe needed to happen or were already happening in order for this to be kind of a springboard to a recovery. I think that there's one thing that characterizes this market right now is low sales activity, and it is like 50% lower or even less maybe in some cases. People aren't buying and selling commercial real estate right now like they were pre-pandemic. And this is just 50% lower than pre-pandemic, let alone the huge, massive amount of sales that we had in like 2021 and 2022. Sorry.
Well, I was saying one of the reasons that I think folks aren't buying real estate, Matt, is because this idea that prices need to be lower. There are buyers at higher cap rates at lower prices. And it's the idea that we need to wait for a final drop in pricing to be able to actually transact. But that has been the wish for the last several years, and we have seen a material drop in pricing. It doesn't feel like it's happened overnight, but we have.
Yep. I think you said it really perfectly. You're looking for cheap, but it's cheap today. Cheap's not going to be in the future. it has been, and they make a huge point here. They say, most industry benchmark indices show aggregate U.S. CRE pricing going down anywhere from 13 to 21% from their mid 2022 peak. Aggregate CRE valuations endured steeper declines in only two other periods over the last 40 years, which was the early 90s and the great financial crisis. And you can see that you can see this, how things are trending. In the early 90s, it did fall and then it sharply rose. And again, during the cool down and like the dot-com crash, things went down. And then during the great financial crisis, prices went down and then they came bounding back up. This is a several years long cool down, I think, and the length of the cool down is important because they're saying that it really builds up this, I think, it's pent up demand for future growth. Now and I think that's one of the things that I wanted to highlight here. And they did say that it's not hyperbolic to characterize the latest decline in U.S. commercial property values as a generational reset. That working theme then is, how does this multifamily market spring back to life? I think one is this cooled off investment market, which I've just described. I do think, though, that there is that risk, right? Because my thought is, if things were really active and people were buying and they were really optimistic, like they were in 2022 and and let me pull up this bonus chart here. Like
good.
in
we are bonus
Q4
content.
Yeah, exactly. In Q4 2021, there was a lot of sales activity. That was, everyone thought things could only go up. This was the most buying, and also the prices were essentially at their peak. Now, if you bought then, when everyone was positive, everyone was hopeful, when the universal optimism almost, then you would have seen an incredible decline. And that tends to be sometimes what happens in investment markets in general. People always think that the good times are going to keep rolling, and people kind of also tend to think that the bad times will continue to kind of stagnate. I think that's behind what people are a little bit. I think that's also a little bit of behind people looking for further price declines, is like, well, they're also at the same time that they're not expecting prices to, or they're waiting for further price declines, they're also not expecting that jump up. And that's, I think, where you can find the value is like, well, no, we're absent the assumption of value increases. We're not absent the assumption of value decreases. I think that's the problem, is like, yeah.
I think people are so anxious for this recovery. And I think that it can be true that, okay, maybe we don't see additional price declines, which there's still a lot of folks out there, again, that want to see lower prices, because they say, look, with the 10-year treasury at, I mean, even if it's lower today at, 423, 425, it's still above 4, which is too high. And to be able to transact, we need to see cap rates at least, closer to the 6% range, even higher than that. We're not seeing that. Yeah. Well, persistently high interest rates, maybe you will see that, but we're just, it's not present today.
Oh yeah, I think that's the big factor right there to unlock everything. Now, I kind of saved that for last, but it is lower interest rates. I can see a gradual recovery, a slow repricing, if interest rates remain where they are. But if in order to like release all this energy for things to spring back upwards, you're going to need lower interest rates. Otherwise, it's just going to it will incline, but not as fast, I think.
I think the only way we're going to get interest rates that low to really cause a major springboard like we're talking about, which I think is kind of a fever dream of commercial real estate brokers right now, and developers. I'm not saying it's impossible, but I'd say it's unlikely. Because look at this chart that you're showing right now. Go look at 2009 to 2022. You don't see a springboard for more than a decade, Matt. Yeah. It takes 11 years, 13 years to get to like a big run up, because that run up that during COVID, that only happened because the 10-year treasury went to 50 basis points. So for short-term rates were 0. And so the only way for that type of springboard would be if there was some sort of economic event that forced interest rates to go to 0. We would need that recession to happen. And I think it's absolutely possible that we have a slow burn and it becomes a war of attrition. And there is a reset, but it's a slow reset. And and rates normalize slightly lower, cap rates normalize, and prices rise over time, and then that's this reset.
Yeah.
The only real true reset that we've been talking about for years, Matt, would be some
Mhm.
sort of recession that would cause enough transaction activity to flush out all these bad zombie deals that were
Yeah.
done during that period of 2021 and 2022, flush them out of the system, wipe the slate clean. That's the true reset.
Yeah.
Otherwise, it's a war of attrition that will take place over the next decade, not over the next year. And I think that's the base case that investors need to be prepared for.
Yeah. Yeah. One of the reports that we didn't have time to cover on this week's Gray Report, still very interesting, from Trepp about the drag in commercial real estate loans and commercial real estate mortgages, and how it's not necessarily delinquent or past their loan maturities, but they're like working things out in a myriad of different ways. And and it does seem like banks are kind of still adjusting and still reevaluating what their expectations are for some of these loans. And yeah, there's a weird limbo status. It's one of a number of things where these borrowers are able to survive past their loan maturities. So that's something that I'll watch and I'll be
Yeah,
digging into.
I think the can, not for all, I think the can is still getting kicked down the road for some borrowers, because I think it's just like this recurring theme of the Groundhog Day that the
Mhm.
lenders are saying, well, we think rates are going to be low here in the next 6 months. We
Yeah,
don't want to
yeah,
start the process now. And it's literally this cycle of every 6 months. Like, we think that rates are going to be lower here in the near future.
yeah. I
Let's
totally,
get ready to, oh
yeah.
yeah, let's keep
I
going.
do think you made a really good point. I think that interest rates, there is a lot of hope and reliance perhaps on interest rates getting down, going down quickly, or going down to the levels that we saw during the pandemic. And to think of what it took, which was a pandemic, to get interest rates that low, there may be an element of a delusion that people think that that's going to happen again just because it happened before. Well, I think short of a pandemic, interest rates won't get that low, and so we probably, yeah, won't see that skyrocketing increase in valuations or sales activity or anything. They're not going to be, kicking the door down trying to invest like they were in 2021. But I still think that a trajectory, at least like some kind of roadmap towards lower rates, will hopefully get more investors interested, and it will see some valuation increases, just not the bonanza that there was in 2021.
Yeah, no, I think to your point, and I think that from the piece's point, the article's point, I think that is true. It doesn't have to be necessarily so binary, in that if long-term rates really do come in below that 10%, that 4% range. If the 10-year Treasury is below 10%, it's kind of in that 350 range. A
Mm-hmm.
lot of deals can get done. I guess the caveat that rent growth kind of at least maintains, maybe, or tries to pick up
Yeah,
some momentum, which I know we're going to talk about in a little bit, and whether that's because of the lease up competition, or if that's a slowing economy. But certainly interest rates coming down would help. And I think there's enough bullish optimism for the
mm-hmm.
multifamily sector over the next decade or so, that
Yeah,
even some short-term weakness in rent growth, if the financing rates were attractive enough and you could at least get some of that positive leverage on more deals, I think at least you'll see the market moving and it'll be
yeah.
transacting. Now, some
I
folks may say that that's not an attractive because rent growth is slow, but you'll at least be able to achieve positive leverage, for
yeah.
those that have that longer term vision.
I think that this kind of like cooler. I think that the low rent growth now is at least balanced, and I would maybe even overbalance towards the idea of the supply balance, the supply coming down in the years to come. So this is what they have in Cushman and Wakefield, and this is part of where I got that figure of this figure where it says it costs. I'm sorry, the apartment prices have gone up 14% since the pandemic, and apartment construction prices have gone up 35%. So more than twice as much it costs to build a new apartment, whereas the actual like value of apartments in general, which includes older apartments, have only gone up less than half of that. Yeah, 14%. So I think that's one of the pieces of the puzzle to maybe getting this recovery is this positive or at least a more balanced supply trends. The supply trends are favorable for investment. I also think that the demand that we've seen in the apartment market is enough to also similarly kind of counteract the the negative implications of lower rent growth. So we are seeing a lot of absorption, record numbers of absorption. That's at least a rejoinder you can have to people that are kind of bummed out. I would also say that this is the uneven, the low rent growth is a sign of uneven performance, which I think is another factor in finding the deal. Like this is it's along the same lines of, well, it's not going to be all prices going up everywhere at once. Otherwise, that'd be a kind of like an inflationary bubble or something where kind of similar to how it was in 2021. It's going to be uneven. There's going to be places like the Sun Belt, maybe, where they overbuilt, where they'll continue to have lower rent growth and probably sliding property values. Whereas in other places in the Northeast and Midwest, we will see this on the map in the apartment list, the rent growth is higher, the property values have a little bit more of a positive trajectory because the supply wasn't as mismatched.
Can I make call it a comment? I don't know what we want to call it, Matt. But we talk about demand a lot, and it's true. Demand it looks really strong right now. Whether that's just affordability because single family homes are so expensive. Never seen this amount of apartment demand in a long time. Okay. Mm-hmm. That being said, like what good is demand other than saying like, well, it could be worse? Like if you're in Austin right now, if you're in the Sun Belt, and we tell you you're seeing record demand. Yeah, but your rent growth is still negative. What does record demand do if it leads to negative sustained rent growth? And so while it's a metric, it's important. We should acknowledge it and say, look, this is like the market isn't that bad, but demand. Again, it's important. Just like in isolation, it only means so much, and where it's translating to. It's not necessarily enough to really push these markets into like a positive growth trajectory, which I think is just fascinating, kind of in the time that we're in right now. But I think don't be fooled just because it's high demand. Yeah, it's high demand it's because it's incredibly high supply. And so the net is not necessarily translating into high growth, which people think high demand means high growth.
Yeah. Now it's going to vary from source to source, but it looks like on this quarterly map I have here from CoStar, net deliveries have outpaced absorption for every quarter since Q4 2021. It does look like there are challenges in the apartment market, but I do think that at the very least there is some signs of an improving, more balanced supply trajectory, of a lot of demand, which again it may not translate to rent growth, especially in light of the enormous amount of supply. But if that demand continues and supply peters off, then that is probably going to lead to stronger rent growth. This is all to say
it is assuming that demand remains elevated. A lot of times demand kind of follows supply, and so as supply recedes, we may see that demand recede as well, kind of step by step.
So ultimately it is just reflective of the challenges, the near-term challenges that there are, and that's one of the takeaways of Cushman & Wakefield is that you need to adopt this medium to long-term perspective. Well, and then they said investors should measure their expectations for the near term. I think that you just need to figure out how to manage your expenses and how things make sense in the near term, because these near-term problems, if they persist for long enough, and I'd say 4 or 3 years, is long enough. If they persist long enough, they become long-term problems. It's not just a hill you get over and then you're fine. It's a plateau of elevated costs and low low rent growth that can really hurt your bottom line if you're caught on the wrong side of it. And I think a lot of people are. And I wonder if they're like their hold periods are being extended for some of the deals. If they're saying, yeah, well, man, the last 3 years are doing bad. Well, good thing now it's a 10-year thing, so we'll get over that. But it does seem like a lot of things are going to be deferred. I do think ultimately, though, in the market, the survivors are going to be able to be the ones that operate in the near term, have their eyes towards the long term, but don't have like long-term gains as like their one shining thing. I think they need to be able to make things work from the day to day, and that's part of the equation. But maybe that's a simple thing.
I know. I think what you're basically saying, Matt, or correct me if I'm wrong, and it's what we've always believed the cornerstone to our investment philosophy of great capital is buy for cash flow. You want to buy something
Yeah.
that's cash flowing today and being comfortable with the return today, with
Yeah.
modest assumptions, being able to grow that cash flow and not bet everything on appreciation that relies often, not always, on outside macro forces,
Yeah.
unless it's something that it's appreciation that you're forcing through some sort of value add in the work that you're
John
doing.
John Chang says, keep your eyes on the horizon. I think it's a great comment. It does reflect the long-term nature of real estate. But I think if you don't look down sometimes, you're going to hit some real stumbling blocks that, that may be in front of you. So that's all I'm saying. And I think that people are, after a few years of this, it's no longer a thing of like, well, now it's hard, but in a couple years things are going to get better. I think people are solving for the now right now, and that's probably the assumptions that they're bringing forward when they're coming to buy an apartment. It's not like, well, got to get over this temporary thing. They're kind of underwriting for it and expecting it to continue in a way that they weren't maybe in 2023, or even 2024.
Oh, Matt, I mean, especially, in 2021, 2022, people were buying these again. That's why everyone was buying on short-term bridge loans. People thought they were going to make millions of dollars within 18 months or less.
Yeah.
They thought they were going to hold it for 12 months. Cap rates would be, somehow they thought they were going to be like 2% or something, and they were going to get 25% rent growth, and they were going to flip out of it.
Yeah. It just sank right there.
It didn't really work.
Yeah. If we want to move on to the crux of it, which so much depends on this, which is interest rates. And I think that this past week was particularly interesting because of the whiplash from one to the other. I think that there's a lot of things and a lot of implications for the apartment market when you're talking about interest rates. But I'd love to discuss some of the major ones here with you.
We could do a whole episode just talking about. There's so many aspects of this. Just one, which we're not going to talk about today. I'm just going to mention it right now, then we move on. But just the quality of data. Ancillary to this story is the head of the BLS was fired because essentially, or the Trump administration, the books had been cooked and that they made it look bad for the Trump administration. But really, I think the story that was the headline. The reality is they're saying you've given us horrible numbers in statistics for the last at least 3 quarters, for the last multiple years. These statistics have been revised, and but we're making critical decisions. The Federal Reserve decided, we're trying to thread a needle here and conduct monetary policy, but the data is not accurate. We thought we had added hundreds of thousands of jobs, and it turns out we only added 35,000 jobs. That's not even enough to keep up with the population growth, which is a completely different picture than had been presented in the Federal Reserve had made their rate decisions on to hold steady. So this goes in what we've talked about a little bit in the past when we've talked about CPI. We're making all of these decisions based on these statistics that we really empirically, at least from my perspective, Matt, aren't that great of quality. The quality is pretty low, but everyone treats them as the gold standard. Are they truly the gold standard? I think that's the overarching thing that I'm continuing to think about. But let's just take it all for what it's worth and just look at where we are. We had a weak jobs report after the decision to keep rates steady. And how is that going to impact potential for rate cuts in the future? Because that's going to be huge for multifamily, as we just discussed.
Yeah, I have a few ideas about this, about the BLS and the information gathered by the government.
We haven't really had a chance to talk about this since
I think that
and all that.
I think that the firing is it's still going to raise questions over. Well, I don't think she was. This BLS official was fired because the data wasn't quick enough. I think it was because the data reflected poorly and it didn't reflect strong enough. It wasn't giving the right message of economic strength. And I think that firing it in this way opens up the idea of, well, maybe this is political pressure. And and I put it in a similar box of the pressure to fire Jerome Powell because he's not cutting interest rates quickly enough. The irony here is that the weak jobs report maybe makes it a little bit easier to cut rates, but let's have both. Let's fire Powell and put in someone that'll cut rates, and then let's give someone the information. I think that the government, for as flawed as it is, a lot of this revisions where it was due to like they didn't get the submissions for the surveys in time. There were some structural issues. I don't know enough about data gathering to to like comment substantively on this. Only that it is an enormous apparatus. I think that the enormity of it makes it very difficult to rig in the way that's perhaps suggested. I think that there is no more accurate or the combination of accuracy and comprehensive,ness, the data gathering that happens in the United States, that's pretty good. And I'd rather have the power of the United States behind that data gathering than like a private corporation. I think there's a lot of people that rely on these numbers, and as bad as they are, because they do get revised or whatever, I think that they have operated for a fairly long time, and maybe it's personal, but there'd be a lot of information that businesses rely on that if they lose faith in it, then that I think that's not a good thing. There's a lot of money that depends on it, and a lot of money that's generated from things like the permits and starts data for housing. And it may not be perfect, but tons of people are drawing on this information and deciding where to invest or what to do or what to buy and sell. So that's like my little piece. I just don't see the alternative. Is it like a kind of cornucopia of little different data sources on everything from like copper prices to corn futures or whatever? I mean,
let me ask you this, Matt. Matt, let me stop you. Okay.
Yeah.
When you, Matt Bosnacker, you're going to go figure out what the rent growth is in a market or nationally, where do you go look?
Well, you're right.
Do you go look at CPI?
See, I don't think that, but
why do you look at RealPage, you look at apartment lists, you look at Yardi, you look at diversified sources, and this is such a specific example, Matt, you aggregate them. We do our own research to find a more accurate result instead of relying on the CPI. And there are multiple employment agencies that do their own surveys of employment that are much more accurate. Why do we need to rely, and why are we using the government source, which is wrong and flawed, just because it has a government stamp on it? It's like American cheese. Like that's what we should eat.
Yeah, I think that
I'm gonna have some Vermont cheddar. I'm sorry.
I think that
you can take the Kraft single. You can take the American, cheese all day long, but there are better products of data and information that are out there. And I think this idea, they've done a bad job. I get it. The optics look horrible. And that's where it's like the Trump administration, sometimes it's like they decide to shoot themselves in the foot. Because it's like we're firing them because it doesn't, we think that we want to show that we have a strong economy. That's not the message. The message is they've done a bad job, and it's creating material risks to our economy. We made a critical decision for the macroeconomy this last week off of flawed data.
I'd like to compare the ADP
I think it's
numbers
pretty bad.
For the jobs numbers. I'd like to see how the ADP numbers compare because I'm not sure of. I just don't know enough about how these have been accurate. The fact of these revisions may be a structural fact. It may be policy that we think that it is different because they did raise alarm bells. They're like, there will likely be revisions to this data, but because of some rule they probably had, they had to give it time. Believe what you want. I think that the government,
ADP, so the ADP uses actual payrolls. They're running the payroll. It's like using RealPage data or Yardi Matrix data. They're running the payrolls. They see how many people are hiring. There are other payroll services that we can do the same from and aggregate that data. The BLS, the way that they do this, Matt, is they send a physical letter out on weird stationery that shows up at your office. We've received them. I've looked at them like, what? You're supposed to fill out this 10-page government survey. It's the most inefficient thing of all time.
Yeah,
and and what they're saying is, and what the Trump, and I'm not here to defend the Trump administration at all. But what they're saying is we need to relook at how we're doing these statistics. We should be doing these statistics in a more modern way, and the entire BLS needs to be reorganized, which I agree. I mean, we've been complaining about this government data. I mean, they just took the year off for COVID, Matt. They just stopped reporting. Like why? Like that? We, as the greatest country in the world, for whatever that means, we should have data that is consistent and accurate. And we have private organizations that are doing it. So maybe we could have a government organization that's, that's aggregating that private information and making reports.
Yeah,
But
I
what
think there's
we've been
something
doing
with
hasn't been working.
we can talk about like the maybe doing it their methods of gathering the data. I think that as a data source, government, you can vote them out. As a data source, ADP, I know there's a market that you can use, but it's a less direct. There's there's a little bit of a question on some of the data sources.
You can't vote out these bureaucrats, Matt, in some of these agencies. You can choose to use a different private source, and you can, Matt. We make our own data. I mean, you and I, you personally, with John Chapman, myself, and the Great Capital team, we've done our own research. We do. Why do we do what we do? We just let government do all that work for us.
I've done a little bit of reading, not a whole lot at all, but I just know that there are standards in there, and they may be bureaucratic, and they may lead to a great deal of delay. But I'm guessing that there's a lot of standards that are in the interest of accuracy, and I don't know. I just I feel like
it doesn't seem very accurate.
Well, it's slow.
I'm just saying we're spending all this money. We're spending all this money. Like, it's not cheap. There's multiple buildings of these people that are apparently putting statistics together, and we can get like a small handful, and we can probably produce better information.
And ADP is doing it and figure out what the
ADP is doing it as a side gig. ADP is doing it as a side gig. They've probably got like I don't know. They've probably got 10 guys in the corner office. I mean, they're slanging payroll software. They're running payroll.
I do think that there's probably some other way that they could figure that one out rather than surveys. But yeah, that's that kind of leads me into and I'm glad I had this discussion, because I'm going to be thinking about this afterwards and really digging into what were the reasons behind this revision, and was it related to kind of structural rules? Was it related to other kind of factors that they didn't know beforehand that they're factoring in now? And I'll have a better answer. And there probably is an answer out there, and I apologize for not knowing that. I just still have
Come back with an answer that's not the New York Times headline, man.
Right. All right. Yeah. That's fine. I appreciate this. I like to hash this. Out because that's one of the things that I was talking to people. It's like, well, do you trust the government where they have their own, set of rules and incentives, or, what would the alternative look like? And I think, I just think it's a really interesting, because one of the things that government does, other than collecting taxes, is collect and process a great deal of information. And so it does. I think there's an intuitive sense that what you said is right. Like, why can't it be more accurate? They have all these people, they're collecting taxes really well. So why can't they transfer that to the kind of other information? And maybe I'll learn that, there's a lot of stuff that they do that is wasteful. But I that's the limit of my knowledge at this point. I did want to note really quick here. I did have a section we like to call good thing, bad thing. And good thing is a rate cut next month. Possibly. We've beaten around the bush a little bit, but one of the things that the job market might end up bringing is is signs of a softer economy that would lead Jerome Powell and the rest of the Federal Open Market Committee to decide to cut rates. That the bad thing here would be the economic downturn. I think we wouldn't be cutting rates because inflation's low. In this situation, we would be cutting rates because job numbers are low. Now, inflation could come down, but recently it's been kind of hovering at the same point. We had just described how these several months of jobs numbers were revised down, but I think on balance, lower rates would unlock a little bit more of economic activity. And to your point, like, I don't know, I'm going to wait for another month of jobs numbers before I really trust the ones that are put out now. Let's see how the dust settles when it comes to this information. The Fed's dual mandate again is inflation on one hand and jobs on the other. So they want to keep inflation low and they want to keep jobs high. And I think that, if what did they say? Front-loaded shipments ahead of anticipated tariff changes caused a temporary distortion rather than a sign of stable demand. That was an explanation of the higher than normal GDP, or at least the elevated GDP that they had. I'll pull this up here. And they said if you dig in more closely to those GDP numbers, there's actually a little bit more softness that could be revealed. There's labor market cracks. There's underlying demand softening. It's cracking in the wrong place, softening in the wrong place. I don't know. There just does seem to be some shakiness in the economy. However, it's not as dramatic and clear cut, especially when things are getting revised to and fro. So I think it is definitely worth waiting another month for more data. I don't know if the data is going to be there when we get there. Is Sydney Sweeney going to be the head of the BLS? Maybe she's going to bring in her genes and attract the right kind of attention to this issue, and we'll finally get some good information, or at least it'll look great.
Well, Matt, I don't know if you saw a picture of the last head of the BLS, but it would be an improvement.
All right. Yeah, the optics. All right.
How can you do any worse?
Yeah.
No, so it's a great question. I mean, because in this slowdown in GDP, slowdown in hiring, I mean, you can see business owners everybody's in stasis. Again, no one's really able to make a decision. And again, whether it seems like we have some clarity, but at the same time, it's like the clarity points towards things are softening, doesn't necessarily make a business owner say like, oh, I'm going to go hire a lot more people. But that being said, ever since and this is what you were really pointing on earlier related to rent growth, but there is this like pent up demand and people are like ready to go, but they need that clear sign. And contextually, tariffs, the majority of tariff uncertainty is most likely behind us. Not completely, but a lot of the tariff uncertainty is behind us. Some other uncertainty is things are slightly more certain than they were 6 months ago. We don't have a war in, Iran, in Israel right now. I mean, there are some clearer signs. And if rates were reduced slightly, the business community in all sectors would be very excited, especially if you combine that with the new, the big beautiful bill, not necessarily the spending pieces of it, but at least the tax cuts. Businesses are very excited for that as well, or at least the sustaining levels of the tax rates as they were back in 2017. So we, again, which we've talked about, even before we knew about this weak labor data, is, we're close to the sweet spot. The economy isn't maybe in a horrible spot, a little bit weaker now with the economic data. But if business owners are given the green light, that may be what we need to create this reset, not just for CRE, Matt, but really for the next cycle in the economy.
Yeah. It's hard. It is present in both the rent growth, which I'm showing here. Apartment Lists has just released numbers for monthly rent growth, which was a flat 0 in July, which normally is higher in the summer months, and year-over-year growth at now -8. Apartment Lists usually has the cooler end of the spectrum when it comes to reporting rent growth, but still, I think. And this was one of your larger points that you were making earlier, is this uncertainty may redound to the detriment, I guess, of rent growth and apartment demand. If people are uncertain, maybe they're staying in place and not moving around, and they're just not renting. They're not making those decisions, and they're not moving up necessarily. I think especially if they're like if the jobs numbers are correct, and then that means, they're not getting new jobs. And so they're not moving into that new apartment. And, but I will say all that being said, and I've talked a little bit too much probably about these near-term struggles, right? And we've got to fight this low rent growth, and we got to figure out how to function here. I think for some regions, for some places, it's going to be an easier fight or a quicker fight than others. I think that the Midwest, as you can see here in the map, there's more red here than blue, and the same thing in the Northeast, very almost universally red rather than blue. The blue is the rent decreasing, the red's the rent increasing, and the Midwest and Northeast doing a lot better than the West, than the Southeast, this kind of collective Sun Belt. And I think that is.
I don't know if you noticed I don't know if you noticed my background for today.
Oh yeah, was that the Golden Gate Bridge?
Yeah.
What is that?
Yeah. Number one rent growth market
Yeah,
in the
yeah,
nation according to apartment list right now. So I
yeah,
figured it was appropriate. Now they're off like what, like multiple years of negative 10% rent growth.
yeah, yeah.
So it's kind of like they're just catching up. But
Hmm.
hey, I welcome a San Francisco that's not
Yeah, for sure.
I mean, I welcome San Francisco. That's a great place to visit because it hasn't
Hmm.
necessarily been the last 5, 10 years or so. San
And
Francisco's
this is,
great.
I do
It's
think that
great.
it is an example of like the uneven market that I was saying that could perhaps lead to some opportunities if we're looking for like a reset condition where you buy low and sell high. Maybe you find maybe a lot of people are dissuaded by a market that seems overpriced, but maybe there's some in a certain submarket that you find. Just like the regions, everywhere is not a Tampa. Everywhere is not a like a Naples, which has negative 4.5% rent growth. Just but I think that those are drawing down the average. And if you find it some place in Kansas City or let's see, let's scroll over here. Lansing, I think, is doing really, really well. If you find areas like that, then there's just a lot more legs. That being said, even the Midwest and Northeast, they're seeing in general lower than normal rent growth. It's not like they're back to normal and the South and the West are doing very poorly. There is a general slowdown in rents. It's just that it's being minor and it's very slightly felt, I guess. It's very weak, this slowdown
Yeah.
in the Midwest and Northeast. Yeah.
It's interesting, man. I mean, it seemed like demand, as much as again demand hitting the headlines, really sputtered out after March, when typically we see that sustained rent growth peak, in June and July, and so we
Yeah.
kind of missed out on several of the top months for rent growth. And as you mentioned, we've been talking about, this weaker jobs report, I think,
Hmm.
paints a clearer picture. I don't think it's the only reason, but I think it combined with that, there's still a lot of lease up concessions. So,
Yeah.
owners they don't have the pricing power to be able to raise rents that much. But then, yeah, there's still uncertainty out there. But then, people aren't being able to go out there and just get a job as easily as they could. It's not that
Hmm.
strong of a job market. Maybe it's not horrible, but when we were kind of scratching our heads a little bit, as recently as last week,
Yeah.
on why aren't we seeing more rent growth when starts are really declining, lease ups are kind of nearing the end of that lease up period, although there's still competition. It seemed like the evidence should point towards rent growth. We weren't seeing it. This helps explain that a little bit.
Yeah. Yeah. I agree. Yeah, I just have it up here. Again, like it's crazy to think about how from basically the end of 2021 into maybe even the third quarter of 2025, every single quarter, as measured by CoStar, net deliveries have exceeded absorption. Now, RealPage has another number. I think they have much higher absorption numbers, and they have it exceeding absorption. But we're still working through the generation high of apartment supply that was built in the past few years. I think that we're approaching a undersupply, maybe, but it's going to be spotty. It'll take some work to get there.
Agreed.
Yeah.
Agreed.
Yeah.
Well, Matt, we can have I think we should have a juicier debate over data sources and all of that. But I'm glad we got a little bit more clarity this week.
Mhm.
We're gonna need some more for next week. This is a great slate of articles.
We'll bring it. Thanks.
It's great. Make sure, if you enjoyed this episode, you're a multifamily investor, owner, operator, you're in the industry, make sure you subscribe to the Great Capital YouTube channel. We do this every week. We also put out all kinds of different types of videos related to multifamily investing. I mean, if you are a credit investor, don't forget Great Capital. We've got a new deal. It's very excited about. It's in Indianapolis, suburban, A-class, greatcapitalllc.com. To learn more, there's a button, click it, give us your email address. We'll shoot you over the deck. There'll probably even be a link in the description to learn more.
Oh, yeah.
But yeah, press the like button, give us a comment. We'll get back to you. And thanks for watching this episode of The Great Report.